Huge day for U.S. stocks. There's a lot here that's working in favor of bulls and perhaps what even meets the eye on the surface after a big rally. Few things that stand out to me. Number one, technically, the levels that we've been watching, the charts we've been watching, did finally break. We've been looking for that. For the S&P 500, it meant a new high. For the NASDAQ, it meant getting out of this sideways triangle it's been in. So you can see for the NASDAQ there, the purple lines, the way we broke through that. The whole point of the risk radar and the caution that I've still had is that the NASDAQ arguably has been downtrending. The fact that you get that breaking out at the same time as the S&Ps break out through their range, these are the technical indicators. My point was that I didn't think we'd be stuck in that 56 range much longer for S&Ps, that kind of binary situation right now where the market was either going to decide that we're cutting big because of bad reasons or we're cutting big out of victory against inflation. The market here telling you today in the response to the Fed now, the real move here, not the fake move from yesterday. If this holds into the weekend, absolutely the real move, that an immaculate landing actually might be a real thing. I mean, this is serious stuff, as we heard from Jem Carson earlier in the show, and a lot of other smart guests who have been here basically embracing the concept of historical patterns breaking and history not really applying when it comes to some of the trends that arguably were negative for the economic outlook. With the Fed going 50 here and potentially giving some support to the economy in a very real way, the market is expressing a lot of optimism here that not only we're getting the soft landing, but something like Immaculate, and maybe we can just continue on our way to a fresh new cycle. Here's why I'm thinking that. Look at bonds. The 10s to the 2s are really important here. We got a different type of steepening in the last 3 days. The 2-year yield bottomed out early in the week. The spread now that's been happening is the bear steepener. Now, the last time this happened in the fall of 23, the market actually didn't love it, but the argument that I made then and that I'll make again now is that this is the steepener that you want. You want yields going up as the bond market steepens. That's different than the traditional event of the Fed cutting because the recession hits. That's the bull steepener that had been going into this decision. That was the bull steepener saying, Fed, you're too tight. You've got to cut or else we're going to hit recession. Bear steepener now is saying there's potential growth prospects being baked in here at this point, and that 50 might have an active force to support the economy, at least stabilize it, maybe even add some growth on. At the same time, you've gotten recent GDP expectations ticking higher. Suddenly that adds up. So the 10-year going higher while the spread is going higher through bear steepening is very encouraging versus the bull steepening. That's telling us that the Fed really is doing something positive here. The other thing, look at the crypto markets waking up. This is going to really tell you if we go into like full-throated risk-on FOMO-style trading. The red light stays on Bitcoin until we can get above the previous high. We still haven't done that, but it does look like there's a good bit of volume pull up into 67. So we'll see if Bitcoin can get there. That'll tell you that really you are turning into a more risk-on. Now, I've said before, though, my favorite rallies are the ones where Bitcoin's not participating because I think they're much more healthy. If you do get Bitcoin participating, though, it just tells you that this is more a sentiment-driven market. That's good for short term. It might have some caveats in it, intermediate to long term, that perhaps were too frothy. So that one kind of maybe a coin flip. But so far, it's basically 2.5, maybe 3 out of 3 indicators here bullish for stocks. The last one, the only one I'm worried about, is NVIDIA. That's the only box that's not quite getting checked here. Rejected at 120 again today. Just get that stock back above 120 to make me feel completely safe about everything. But still, we had enough breakouts here and enough bullish check boxes on the list to flip the light green, of course. As I said, there was not going to be a yellow. I did not think that we were going to get range bound. That was a very important part of the framework, that we were going to have the move, so we got it. And bonds, I think, dollar in a pretty good spot here as we've seen push back there in both directions. We'll see how we end up tomorrow. Hopefully stocks can continue the strength, but you do want to see it, I think, with bonds still in the bear steepening and the yields going up. If bonds start to rally big, then you might want to watch out for stock market fades, but we're in pretty good shape right now, it seems like, after big technical breakouts. Have a great night.